The UK economy is likely to enter recession in the third quarter of 2022 and remain there until the first quarter of 2023. Our forecast for GDP growth is for 3.5% this year and 0.5% in 2023. With recession expected, unemployment is forecast to rise somewhat over the coming year, peaking slightly above 5% in the second quarter of 2023. In terms of the inflation outlook, we expect inflation to peak close to 11% towards the end of 2022, returning to around 3% a year later. Three factors are expected to drive this fall in inflation. These are tighter monetary policy, for example, higher interest rates, a slowing in energy price inflation, and falls in real incomes. However, the Bank of England's Monetary Policy Committee must continue to be cautious as it walks a fine line between tightening policy, that is, raising interest rates, too quickly, which could worsen the recession, and too slowly, which could increase the risk of high inflation becoming embedded in expectations. Earnings are expected to rise by 6% in 2022, and because this is substantially less than the rate of inflation, we do not expect it to lead to a wage price spiral. With prices settling indefinitely at a higher level relative to incomes, real household incomes are forecast to fall by about 2.5% this year. And this is the largest fall in real income since records began after the Second World War. And it's expected to remain over 7% below their pre-COVID trend going beyond 2026. Three shocks have combined to shift real incomes onto a permanently lower path. Firstly, Brexit has raised the cost of imports from continental Europe and incentivized households to switch towards more expensive domestically produced goods and services. Secondly, the rise in energy prices resulted in a large terms of trade shock for the UK. And finally, discretionary fiscal tightening over the 2021 to 24 period following the shock of COVID-19 has reduced resources available to the private sector. Now, with government budgets set in cash terms, the government's debt and deficits will be lower as a percentage of GDP, with the deficit forecast to fall to around 5% in 2022-23 and 1% in 23-24. These drops in debt burdens occur because the amount of money owed remained constant, while higher price levels pushed up measured GDP. This means the government has more room to borrow to mitigate the effects of these three shocks that I've mentioned earlier. And we suggest some of this extra fiscal space is used to redistribute resources to the most financially vulnerable households. Finally, we would advise the government to focus on minimizing the negative effects of Brexit by reducing the trade barriers between the UK and the European Union, including the Republic of Ireland. We would certainly advise against risking a trade war with our nearest and largest trading partner, the EU, by overturning the Northern Ireland Protocol, which has supported productivity and output growth in some sectors in Northern Ireland.